Okay, so we are a little bit late for today's session. I do apologize. The gremlins were out in full force today, trying to prevent me from doing our webinar today, which is on the tax implications of creating a holding company. So, as a little bit of housekeeping, for those of you who are watching on social media, feel free to post your questions or comments down below. We'll have a teammate relay those questions over to us live in this session and answer them for you here. If we don't get a chance to do that, we will make sure to come back and answer those questions so that you get in a full response. As I mentioned, today's session is about creating a holding company, tax implications of creating a holding company. So let's start with, a little bit first about myself and what a holding company is. So my name is Andrew Wool. I'm the managing partner here at CPA 4IT. We're an accounting firm specializing in service-based professionals, specifically IT contractors. So keep in mind that anything I talk to will be from the lens of helping independent contractors, but many of these tax strategies will apply to other businesses as well. And so let's talk a little bit about what a holding company is, and why you might consider setting up a holding company. Because we have seen situations where people will incorporate and want to create a holding company right from day one, which, nothing wrong with that if that makes sense, but usually not the right decision for most people because you'll be incurring some costs without receiving any benefit right off the bat. So first, let's explain what a holding company is. A holding company is another incorporated entity that doesn't produce any goods or services. The primary function of this company is to hold assets, typically in the form of investments, and that can include investments in other companies. And when we talk about it in terms of our client base, what we're typically doing is having a holding company that owns or has shares inside of an operating company so that that operating company has the ability to flow money from the operating company into the holding company. And this provides benefits like tax savings and asset protection. And that's done through a number of different mechanisms. One of the most notable is in helping to reduce the erosion of the small business deduction, which can happen once you have investments inside a typical operating company. Now, the reason that you would go to the expense of incorporating a new corporation, as well as paying the additional accounting fees for the new corporation, is to receive a financial benefit of doing so. There are some non-financial benefits that you're going to get with it, but typically most people aren't going to go ahead and set up a holding company without receiving some sort of financial benefit. And we do that in a number of ways. One, as I mentioned, there is the erosion of the small business deduction, which for those of you who are not familiar with it, if you have more than $50,000 of passive income, every dollar over $50,000 will begin to erode your small business deduction limit. And again, for those of you who are not familiar with the small business deduction limit, here in Ontario, small businesses only pay 12.2% compared to the general rate of over 28% and can go up from there. So the small business deduction is substantially lower taxes than the general rate that is paid on passive income, as well as any income over the small business deduction limit of $500,000. Now, your passive income is never eligible for the small business deduction, so it's going to pay tax at the general rate. But where a holding company comes into play is in your ability to use that along with some strategic tax planning to move money that would normally be taxed at the general rate into money that would be taxed at the small business tax rate. And how we do that is we will put whatever expenses we can in the holding company. Like you can think you have some flexibility in things like home office and cell phone and stuff like that into which company that they would be charged at. But we would put as many of those expenses into the holding company as we could to bring the holding company's passive income as close to zero as we possibly can. And if the traditional expenses like home office and cell phone and stuff like that aren't enough to bring it down to zero, we can declare salaries in the holding company that we can use to bring that down to zero. And we would, because we're taking salary from the holding company, we might take less or potentially no salary from the operating company, meaning that the operating company now has less expenses in it and more income, but it's more income that's going to be taxed at the small business rate as opposed to the money that is in the holding company that would be subject to the general rate of tax. Now, there is a little bit of leeway that we have if you want to have just one company and you have some passive income, as well as any direct costs related to that investment income. Like you can think any fees that you might have from a brokerage or an investment company that's helping you to manage those. We can apply those fees directly against the small business income to bring it down to zero. So typically, we're not going to set up a holding company until we have investment income. So not only do we have investments, we need to have investment income. And typically, we would want to see that investment income be above about $20,000. Because once you've got about $20,000 of passive income and you're able to move that passive income into operating income with some strategic tax maneuvers, then you're going to save typically at least 16% on $20,000. So you're looking at about $3,200, which should be enough to more than cover the additional costs of the accounting services for the holding company. And really the only downside to setting up a holding company is that you have some added complexity, which means added costs in both the setup and the maintenance of these accounting firms or of these businesses. So that's the background of what a holding company is. But let's say that you've gotten to this point and you're actually ready to set up a holding company. What's the best way to do that? And what are the different ways that you can set up a holding company? So the way that we structure the incorporations that we do for clients is we structure them with the intent that your operating company will one day become your holding company. And that is typically the best way to do it because it is the cheapest way to do it. You can take your existing, and so what I should say, let me clarify exactly what the process is if we go that route. So let's say that you incorporated a company with us 5 years ago. You now have, a decent amount of retained earnings and it's generating investment income, and you want to move that investment income into a holding company so that we can use some of these tax strategies to lower the total overall tax burden. So what would happen is your operating company would cease operations. We would incorporate a new company. That company, you would need to sign a new contract with your end client under that new company's name. And there are ways if you want to keep the name of transferring the name, but you do need to set up a new contract with your client. And that's sometimes where we run into the reason we have to go with the second route is some people have grandfathered contracts that it would be difficult to change or, negatively, it would have some negative financial impacts if they did change it over and had to get a new contract signed. In which case there is a fallback option, which I'll talk about in a second. But assuming that you can sign a new contract, this means that we can just incorporate a new company. And if you're an existing client, you get our friends and family discount. And, that can be very cost effective to do. This new company that we incorporate becomes your operating company. And because we're creating it from scratch, we can set who the shareholders are. The shareholders of this new operating company will actually be the holding company. And what this allows us to do is to do dividends to the shareholders. And when it's an intercompany dividend, those dividends are tax-free. So there's no tax consequence of moving the money into the holding company so that as you continue to earn income and generate income, we can move that over to the pre-existing company that you had that was originally your operating company that's now your holding company, and it can continue to grow and have more investments, and the strategies become more and more beneficial for you. Now, if for whatever reason you have an existing contract that can't be changed, or there might be some other reasons that prevent you from rolling your existing operating company into a holding company, then what you can do is you can do a Section 85 rollover, and we can move the assets over to a new company that will become the holding company. That allows us to exchange some shares and change the share structure of the existing company. However, caveat on that is, while that is possible, that is something that is beyond the scope of what our firm is able to do, and we would bring in a tax accountant to help and assist with that process. And there would be additional fees. It wouldn't be eligible for that amazing rate that we have on low cost incorporations. So you'd have to work with a tax lawyer to do that. It is possible, but it is just more costly. So I want you guys to be aware of those options. Now, if you are ready to go ahead and set up a holding company, the steps that we would go through, the first thing we want to do is review the financial statements and the incorporation documents to make sure that the structure of the existing operating company is will be well suited for a holding company. Assuming that's the case, we would then process some articles of amendment to rename the existing company, and then we would go through articles of incorporation to incorporate the new hold company. And I would say the articles of amendment on renaming is not required. It's optional, but you do have that option if you want to like effectively move the name over to the other company. So you would rename your existing company to XYZ Holding Company, and then you could set up XYZ Incorporated because that name would now be released and be available. That does add a little bit of added time and complexity, but it is manageable. Now, the next thing that we're going to do is typically choose a December 31st year end for the OpCo. I would say with the, for the HoldCo. And what I would recommend is, the reason we recommend a December 31st for a HoldCo, which we don't typically recommend for an operating company, is because typically HoldCos are going to have investments. Investments most commonly are going to have statements that are produced on an annual basis. Now, every financial institution can provide you the information that's necessary to do the accounting at the end of the year based on a non-calendar year. So let's say a July 31st year end. However, almost inevitably, the first response is, we can't provide that. And then you have to be like, actually, I know for a fact that you can. My accountant has worked with your company before in the past. And then they will, oh, yes, you're right. And they will send over the information. But the portals by default are going to be based on the calendar year, and your broker has to go in and make some tweaks and changes, but it is possible. But for that reason, we will often recommend a December 31st year end for your holding company. And if we do that, we would then typically recommend changing the year end of your operating company or setting up the operating company to have that same year end. So if your existing company is being converted into a holding company, it probably doesn't have a December 31st year end. So we would need to change the year end for that. And then the new company we incorporate, we would typically choose a December 31st year end. Now, if you're okay with the added complexity of keeping your existing year end and you like it, it works timing wise for you, you can certainly keep your existing corporate year end. Let's say that's July 31st. And we would then keep that year end, and then we would set up both companies with that same year end. Again, we typically want to keep the holding company and the operating company with the same year ends. It's not a requirement, but it does typically make your accounting easier to come in and be doing both companies at the same time. It makes your planning and coordinating a lot easier for you and your accounting team. But again, not necessarily a requirement. Now, one other benefit of the holding company is it does allow you to preserve your lifetime capital gains exemption. Now, most independent contractors do not actually have a saleable business because typically once you stop consulting, there's no really saleable business there at all. Now, a few of you have multiple contractors working with you or have built apps or are doing other things where you actually truly have a saleable business. And if you're not aware of this, the lifetime capital gains exemption is absolutely amazing because it allows you to sell shares of your business and to offset approximately $1.25 million of capital gains and not pay tax on that, which is absolutely amazing if you are selling a business. Now, again, the problems there are one, you have to have a buyer who's willing to buy shares as opposed to assets. And sometimes buyers don't want to buy shares because if they're buying shares in the business, they're buying the entity and taking on all the legal responsibility that goes along with that. Whereas if they're buying assets, they're not taking over any liability. But if they are willing to buy shares and you can leverage the lifetime capital gains exemption, as I said, you got about 1.25 million that you're not going to pay tax on. But in order to do that, you have to purify the corporation because there are rules in place that say the majority of the business has to be the majority of the income has to come from operating income, and you can't have passive income in there. And there are some rules around how much time that has to be for. So if you are in that situation, you are considering selling your business, that is certainly a conversation that you should have with your account manager to make sure that the corporation's assets have been purified so that you are eligible for the lifetime capital gains exemption should you want to go down that route. But that's another tax benefit that you're going to get out of the holding company. As we said, there's also that benefit of being able to be strategic about where you take expenses so that we can potentially move money that would be normally taxed at the general rate into the small business rate. But we can also leverage holding companies for long-term estate planning. And there are strategies that we can use with estate freezes so that we can lock in the value and have any attributed growth go to whoever is the beneficiaries as opposed to the corporation or the estate. So there's some strategies that we can do there. It also does give us some benefits of succession planning where we can leverage the corporation as a tool that can be used by your estate to get out money as tax efficiently as we can by pulling money out over time and seeing it continue to invest. And, because one of the things that I have completely jumped past is our overall strategy that we use with a lot of our clients when it comes to organizing your finances, creating wealth, and transforming wealth into a legacy. And I've said this many, many times, but I'll repeat it here again because it's absolutely critical. The goal of what we try to do for all of our clients is to help you build money up inside your corporation, hopefully getting to the point where you need to benefit from a holding company and hopefully generating so much money inside that holding company that you can live off the annuity or the growth without ever needing to touch the principal. That means that you could live forever and still have an estate to pass on to your children or an important cause or whatever you have for you. And if you can get to that point of being able to live off the annuity or the returns of your investments, then you will have a sizable nest egg to leave to your children. And the best way to do that from a tax perspective is leveraging corporations and the benefits that come along with them. And that's something that can actually be passed along to your children and can be done very effectively by leveraging things like estate freezes so that we lock in a period of time and that future growth is attributed to the children as opposed to the estate so that it's not taxed upon death. So a lot of benefits that we can do from a strictly financial basis, but also from a limited liability, which are those those soft benefits that we talked about earlier that, hey, they're nice. I probably wouldn't go and set up a holding company just to have these. But again, they're going to provide protection from creditors and protection from lawsuits, because effectively the holding company can shield your assets in the case of potential legal action. And that's again including strategies or issues around things like PSB. And that's where, if there's ever an issue with PSB and you have a holding company and you move all the assets, you can throw your hands up and be like, you're right, I am a PSB. Take all the assets of my corporation. Haha, there's nothing there. And that's more meant as a emergency backstop, not as the best strategy. The best strategy is to prove to CRA that you are not a personal service business. But again, one more level of protection that if we're wrapping ourselves in bubble wrap, we want to put as many layers of protection as we possibly can to protect ourselves. As I mentioned earlier, again, you can do tax-free dividends with a holding company. And this just allows you to move money from one company to the other without having to be taxed again or having double taxation. And that is the tool that we use to move the funds. Now, the one thing I want to make sure is clear is there are intercompany loans and there are intercompany dividends. You might be moving money back and forth from one company to the other throughout the year, and that's an intercompany loan. At the end of the year, you'll sit down with your account manager, do your tax planning, we'll look at the retained earnings of the corporation, and at that point, make a plan as to how much money to dividend up to the holding company and move out. Typically, we'll leave some funds in the holding company for operations, but the majority of the assets are going to be dividended up to the holding company so that, if we do run into any issues, we can throw our hands up and toss the company away for lack of better a better expression. And again, the number one thing is preserving the small business deduction limit, because not only are we going to be able to move money from what would be taxed at the regular rate to the small business rate, we're going to preserve the small business deduction limit, because the small business deduction limit will be eroded by passive income. And the bad news is they will look at the cumulative passive income across all your companies. So if you still have more than $50,000 of passive income in your holding company, it will begin to erode your small business deduction limit in your operating company. But the strategy here is we're going to try and get the small business or the passive income down to as low as possible by moving as many of our expenses over to there so that hopefully we don't exceed $50,000, because it would effectively have to be over $50,000 plus whatever you're taking out in annual salary or remuneration before we would start eroding the small business deduction. Because again, that erosion is based off the net income, not the gross income. So if we have a bunch of expenses in the holding company, we're bringing down that erosion of the small business deduction. So those are really where we're getting the greatest financial benefits out of that. I do want to make sure to check if there's any questions here. So I do see we have our first question that's come through. Is the best setup to have a holdco as a sister company or a parent company? It's a parent company, typically. And again, that structure is so that we can have shares in the operating company held by the holding company, and that is so that it allows us to dividend up those shares to the parent company. So that's typically the method that we would go. So again, I want to take this moment to open it up for any other questions and answers. For those of you who are new to us, I want to remind you that we do offer a free initial consultation, because obviously I'm giving very generic information here, and the best solution is a tailored solution. And we'd want to make sure that we're structuring things correctly, given your individual situation. We do offer in-house paralegal, which means that we can do those incorporations, we can do those minutes, we can do some changes to existing share structure within certain limits. Again, for more complex situations, we will bring in a tax accountant to do those more complicated structures. And then, of course, we do have our unique industry expertise, our unique proprietary tools like our benchmarking analysis, where we compare you against the average to see if you're below and missing out on deductions that you might not be aware of, or above the average and potentially, at risk of triggering an audit. And then, of course, we do have our audit representation protection, which means we'll represent you up until the third and final stages of appeals at no additional cost to you, so that you can have the confidence and the peace of mind to be able to claim as many of those expenses as you are legitimately entitled to. So we have another couple questions coming through here. So we can convert the current corporation to a holdco by amending the articles of incorporation. Yes, you can. And in fact, one of the things that you can be aware of is you don't even have to amend the articles of incorporation. There's nothing in your articles of incorporation that says this is an opco or this is a holdco. When we file your tax return, we do indicate the majority, like where the majority of revenue is coming from and what type of business it is. And we have to put a standard industry classification on that. That's where we indicate whether this is effectively an operating company or a holding company. So you do not need to change or amend the corporation, but oftentimes people will, if, like I said, they want to keep that name, or there's other reasons we might want to change that. That is possible to do articles of amendment. It is not required to do that, to take your existing operating company and make it a holding company. So as long as you're okay with not using that company name as, or not having your holding company called XYZ Holding. And sometimes it can get confusing because we have had situations where someone has XYZ Corp and XYZ Consulting Corp, and then it gets a little bit confusing for them. So sometimes people like to have completely different names, and that's where you'll use articles of amendment. And then we've got another question here. Is it for all types of investments be in the holding company? Example, purchase of condo that will be rented. Yes, absolutely. I would say all types of passive income you want in your holding company. And that is, again, where converting an operating company to a holding company also is a great strategy, because oftentimes as you're building your net worth, you will start to have some investments and they'll already be in the existing operating company. So if that just becomes the holding company, there's nothing to transfer or to move out. Whereas if we did need to create a new company, that's where we would use the rollovers as a strategy to mitigate things that would otherwise trigger some taxation. And it allows us to move assets over without having to trigger capital gains and to defer that what otherwise would be a tax event. Because if you just move the assets, you would have potentially capital gains or capital losses on what those assets are worth. And a rollover allows us to effectively defer that. So I hope that answers the question. And that looks like that is it for the questions. I'll give everyone another minute or two in case some additional questions come up. Again, we love hearing feedback. If there's any other topics that you would like to see come down the line for these webinars that we do every 2 weeks, we'd love to hear it. We've got some exciting ones coming up, so go check out the events page on cpa4it.ca to see what we've got scheduled. We've got some guests coming in. Just had a call right before this meeting with an independent contractor that we're going to be bringing on, who's written a book on how to be a successful independent contractor. So we're really excited to bring some of his content in to share with you some tips and tools for marketing yourself and all those great things. We've got financial planners and insurance providers. We've even got a client who is a cybersecurity specialist who's going to be coming in and doing a session on cybersecurity. I'm really excited to see if there's more content you guys would like to see us produce. We do have another question that's come here. It seems to be about PSP. Is it correct that if we keep 5 full-time employees in holding companies, it will be considered an active business income? So the 5 full-time employees, that is specifically around PSP. So if you have more than 5 full-time employees, you will not be classified as an independent, or you cannot be classified as a personal service business. Now, typically, you wouldn't have 5 full-time employees in a holding company. We have yet to come across that situation. You would have to be generating so much in net worth to have a reason to or a need to have 5 full-time employees in that corporation. And then, yes, it might be considered an active business, which would actually be a positive thing because that means that income it means it's your primary source of revenue, right? And you can think like there are people who focus full time on real estate development, and that's no longer passive income for them, right? That's active business income. For most of you, if you have a condo, that's still considered passive income because it's not your primary source of income. But if it's active income, we don't need to worry about moving it over, right? So if you grew to that point of having 5 full-time employees, that would be positive on so many other levels. It would be mute whether it's a holding company or an operating company. So I hope that answers your question for you. I got another question that's come in. What about if it's only me holding company? Do we have to add husband's name if the investment is in his name or the holdco name? This way, dividends received, any other monies will be taxed in less amount. So you do not have to be added as a shareholder of the holding company, but we do typically recommend it. And even though there's something called TOSI or tax on split income that effectively prohibits us from doing dividends to you while your spouse is under the age of 65. And that's because you can still do dividends, but they're subject to TOSI or tax on split income, which the Liberals gave us a few years back. And that effectively means you'd pay tax at the highest possible tax rate, which would effectively make it not tax advisable to do. Once the primary business owner reaches the age of 65, then we can do dividends with the partner without it being subject. It's exempt from TOSI. If the primary business is over 65, they can do income splitting with their spouse. So for that reason, we typically recommend adding a second class of shares for the spouse. And it's not required. It just gives us more tools available in the tax planning world, more arrows in our quiver, so to speak, so that we have more strategies available to us. But not recommended, but not required, if that answers your question. Is it possible to move personal investments, mutual funds, ETFs, etc., into the holding company as a shareholder loan? Yes, it is. However, you would trigger a taxable event, which would be potential. I mean, it could be either potential capital gain because you're effectively selling them to your corporation. So that could have a capital gain, capital loss. But yes, you could. The question then becomes, does it make sense? And again, what I would say is speak with your accountant to make sure that actually makes sense. It could make sense because it could potentially give you an ability to draw money out of your corporation over time very tax effectively by repaying that loan. But it also might not. If you have a bunch of money outside the corporation, it's already been taxed and you're not needing to pull money from your corporation, I wouldn't advise moving it in. But again, speak to your accountant about your specific situation. So great. I love to see that there's more questions coming in. We got a few more here. I have shares in another company. Would it be best for me to change into a holdco name before this company is planning to look for a seller or exit strategy by the owner? So I'm not sure I'm reading this correctly. I'm assuming, so like, are you a partial share owner? And what business do you own? What I would say is if that business is looking to sell its business, then whoever the owners are of that business need to look at purifying it, and getting out any assets that are generating passive income out so that they can potentially leverage the lifetime capital's gain. So if you're a partial shareholder, I hate to break it to you, not up to you, but I would certainly talk to whoever is the majority shareholders and make sure that that has been considered if that business is looking to sell shares. Again, happy to have a one-on-one conversation about that if that would be more helpful. It's a partial share, and the shares are in my name. Yep. And again, happy to sit down and have a one-on-one, as it seems like that might need some more in-depth understanding and planning. I got another question here. What, at what point do, at what point, so what the point to other shares if there is a risk with CRA or TOSI? Okay. The reason that you would want to have shares for family members is one, TOSI could be repealed at any given time. I don't think it will, but it could be. Um, so you want to have those options available to you. And if you set up a separate class of shares, it doesn't mean you're ever obligated to disperse a dividend to that class of shares. It just gives you the option available. And from as an accountant, I like to have as many options available to me as possible. And again, as I said earlier, once you hit 65, there are so TOSI has certain people who are excluded. If your spouse is actively working, if your spouse and or children are actively working in your business, then they're excluded from TOSI and you can do dividends. And there are different criteria, and there's different criteria for people depending upon how old they are and how old you are. Again, maybe a conversation with your account manager to dive deeper onto that. But again, the reason that you want to have those class of shares is just to keep options open. You're not obligated to disperse dividends to those classes of shares, but it leaves the door open if it ever makes sense to down the road. Okay, we got changing my shares into old co name. I see. I think I better understand your question now. You're saying that you have investments that are under your personal name. Would those be better held under your corporation's name? And again, they're similar to the question I said earlier. If these are owned personally, you've already paid tax on the money, and effectively transferring into the corporation would give you a shareholder credit. So the corporation would owe that money back to you for those shares. You have to make sure that those shares are transferable as well. It might depend on the individual deal that you have. I don't know the circumstances there. And I would say it might make sense. It might not. We probably need to sit down and have a in-depth conversation. Or if we're not your current accounting firm, you certainly need to sit down with your accountant and have an in-depth conversation with them about that to read the contract that you have, see if they're transferable, and then understand your individual circumstance to see if that makes sense. And I'm not 100% clear if you own the shares personally or your operating company owns the shares. I'm assuming you own the shares personally, but maybe not. Yeah, you own them personally. So again, yeah, would it make sense to transfer it? Probably not. But they may be because, like I said, really depends on how much money you have in your holding company, how much money it's generating, how much money you're taking out of salary. Is this generating dividends or cash flow in any way, shape, or form? Is it banking on a capital gain? How big will that capital gain be? There's a lot of moving parts here that you probably don't want to disclose on a live session to the public. So book some time with me if you're your accountant or your account manager. We'll happy to go through that in more detail. And thank you everyone for your time. I really appreciate you coming out. Um, and again, we're open to doing more sessions geared specifically to the type of content you would like to see. Just let us know what content you'd love to see, and we'll be happy to produce it more. Otherwise, I'll see you in 2 weeks. And thank you everyone for joining us today. Have a great day.